going to shift gear a little bit for this panel session, and having listened to some of the truly inspiring innovation, work, progress, projects, etc., that are going on in what is clearly a room full of the converted. And I think that both Daraka, Paul and myself certainly would see ourselves in that category. But we do different types of work and different types of jobs in the sustainability space. And the panel session this afternoon, or this session here now, this morning, really is relating to business models more generally. So thinking about the extent to which sustainability is something separate or something at the heart of business. And unrelated to the session here this morning, Daraka presented to my CIE Sustainability Subcommittee. We didn't have this planned, it has to be said, in relation to a lot of our reporting requirements. So again, lifting ourselves up from some of the innovation and some of the very creative things that we've heard about this morning, and you can see around the room and during the course of today, and really focusing on how we fund these developments, how businesses and boards and senior management teams think about these developments, and how we embed them into our businesses. So the overall theme is really around sustainable business models. That's quite an academic term. There's quite a dry definitions of that, but we're trying to maybe today give you some real live examples, certainly from Paul's point of view possibly, and what he looks for when he looks to invest, and Daraka's point of view in terms of how she's helping companies report in order for them to be compliant from a regulatory compliance point of view, but also just her experiences of dealing with companies as they try to adapt it. But I'm going to let Daraka briefly introduce herself, and then Paul, and then we'll just start with some questions.
Thanks, Fiona. Delighted to be here this morning. My name is Daraka Dennis, and I work in EY leading our climate change sustainability services team. So the team works across a number of areas, advising clients on decarbonisation, on strategy, on plans, on thinking through how to manage that change and transmission. But what quite often happens is client comes with a very simple problem. And I love that small step analogy where they come and they say, look, we're thinking about this, we have a problem, what's the glide path to this? I need somebody to help me think about how to manage my business model because, something is not going to be here in 5 years' time. And that's why I'm delighted this morning with all the innovation, because invariably when I talk to clients, the solution mightn't exist, but a part of the solution might be there. So it's about thinking with clients, how do they manage the transition to a more sustainable business in a way that brings everybody along, so that my team would work very much in that space. And it's a real challenge, but it's also a real pleasure, because you get to introduce people in organisations to each other. It's quite an exciting time, really.
And Paul?
Thank you. Yes. Haven Green Investment Management is the firm that I founded. We effectively went into existence with a regulated licence from the Irish Central Bank last October. It comes at the end of a 35-year career, hopefully the beginning of a new one, the end of a 35-year career in the investment management business, starting here in Ireland in the 80s, and then more latterly serving as global head of the business on the investment management side at Morgan Stanley for the last 13 years. So one of the ideas for setting up Haven Green was what I would have noticed, particularly in the last 12 years, was the amount of inbound investment management firms that had great ideas in the renewable space or in the climate tech space, let's say in general, which would really have struggled to actually get off the ground, grow and scale. So our role at Haven Green is to try and help those firms to go through that process. It's very much mission driven in terms of we'd like to make a difference in the next number of years with the team that we've put together, based out of Dublin, but with team members in Australia, Japan, across Asia, Middle East, and into Latin America. But the idea behind it is also it's a tough one, because we see, even since this time last year, probably 80 ideas coming through the doors, and we're probably working with 8. So the screening mechanism is quite stringent. It's quite tough, actually, when you have people who are passionate about a project and then they find that this is not ready yet for market, or something that we can't help to be a catalyst in helping them succeed. So that's a tough side of it as well.
Absolutely. Okay, Daraka, I'm going to go back to you and ask you that when that client comes to you and they want to develop a more sustainable business, how do they begin to think about their existing business and whether they fit sustainability into it, above it, below it, from the sides? Just help us understand the kind of framework that you walk them through when they try to become a sustainable business.
Yeah, that is the real question. So quite often what happens is you'll have somebody from, in an organisation that doesn't have a developed sustainability kind of strategy will come in and say, look, I know that my business maybe isn't looking at carbon the right way, and we have a challenge, or we've been asked a question, simple one. Client came in one day and said, I'm actually selling to somebody in Denmark, and they've actually asked me, what is my strategy? And I have no strategy. I said, okay, well, that's not maybe what you need to answer. Let's have a conversation, because there are things you're doing. So invariably you sit down and you say, look, okay, this instance was the need to share the strategy through a procurement process. So sat down and said, right, well, we need to talk to operations, HR, finance, and determine what you are doing. And everyone is doing something, but they might be talking to each other. So it is about sitting down first and saying, well, what's important in your organisation? What's important in the ecosystem that you exist? And it's a concept of what's material in your space. It was a kind of a technical expression in terms of doing a double materiality assessment. But that's where it really starts. But invariably it is at the moment because somebody comes to your organisation and puts pressure on you, or the counter side is the finance question of, I need to raise money, but they're telling me that actually they need to understand my green credentials, and how does that work? And again, it's about working through. So it is simply about saying, okay, well, what's your problem? How do we solve that first? And then there's usually a journey of developing a strategy. There may be no strategy. It might be to answer that one particular pain point, and then work through, okay, well, now that you have that pain point, can you see the rest of the universe of sustainability and how you're going to navigate it? So it's invariably a journey with everybody that comes to us.
Okay. And again, a different question for you, Paul. Obviously you've talked about funding sort of early stage companies in the climate tech space, and indeed a lot of the folks will be here familiar with that. But when you think about the big pension funds, the big institutional investors, we're now seeing obviously a sort of swing against ESG investing, the threats and allegations of greenwashing and such like. Where do you think we are today in terms of global investing, the capital that is required for all of our companies to succeed, big or small? Mm-hmm. And then obviously then how it trickles down then to the smaller companies that are looking for investment.
Okay, well basically it breaks out on a geographic basis that Europe, Northern Europe, down to just above the Mediterranean belt is probably all in on this. So, when you think about pension funds and institutional investors in that space, they are willing to engage and entertain, particularly investment management firms that will come to them with a holistic solution where they can buy the firms that fix themselves, the firms that have great ideas that are commercially scalable and commercially robust. If you go to the United States, which is where that ESG terminology has become more weaponized, and you'll see a transition in that into much speaking more about sustainability and impact as a result of that. I do still think that there is a momentum behind that, and the Inflation Reduction Act has absolutely helped in the focus on that, and particularly in the green hydrogen space, as we alluded to earlier on, where we're seeing people going back to that whole electrolysis technology, which has been around since the 30s and 40s, now suddenly being reawakened in people's minds as to how can you commercially scale on that. So, but I think if you were going to do a percentage breakout of the investors, about 80% of investors in Europe will have some element of conscientious behaviour around their allocation policy. In the United States, it's probably somewhere around 55%. Having said that, if you went back 5 years ago, it was about 25%. So the scale of growth has been quite rapid. And I think it doesn't get to 55 and fall back to 45 or fall back to 25 again. And then Asia, I just think in Asia it's really not taking hold at this stage, too disparate. And I think that's understandable. These are emerging economies in a lot of circumstances. And in effect, adopting some of the policies, more stringent policies that we might have in Europe, will mean that they will never succeed as economies. So, and I do think there is a little element of that responsibility, and I know President Macron is following an initiative on this where, the global north has to think about paying for some of the growth and stability that can come on the emerging economies. So it's understandable that Asia is a little bit more hit and miss on this, and if you did surveys on it broadly, it comes in at about 30%. But mainly biased because of the Japanese interest in it, above all else. And Australia is a commodity-based economy, so this is something that's difficult for them to embrace. But you'll see some of the superannuations in Australia that are beginning to look at it. So broadly what we try and do is we try and connect asset owners to investment management firms that can actually make a difference, and that's a great way for us to do it because you raise a significant amount of money with an investment management firm, they can actually move the needle in projects. Or you find projects that actually can become commercially scaled and viable. It is important to note, though, that if you're thinking about pension funds, you're thinking about these big asset owners. Everybody we meet, or most we meet, that talk about individual projects explain to us that we're talking to the next unicorn. We're not, and in 80% of cases will not be. And I think the problem you'll have in trying to pursue those bigger asset owners is that they have to have a runway where they can put meaningful amounts of money away, while also remembering that they're investing on behalf of pensioners. So in 20 years' time, someone walks into a post office and gets a decent pension because you didn't just embrace some missionary zeal, or you decided to take on a project that didn't have a commercially viable outcome in the longer term, because that's the job of a pensions manager or any of these institutional investors.
Absolutely, and I think that as chair of CIE, I also have responsibility for the CIE pension, so that's a significant. Paul's going to be already talking to me about that later on, no doubt. But I do think when you look at some of the definitions of sustainable business models, I mean, the word sustainable is what I think we all understand it in terms of climate friendly, but also sustainable as in it has a long life and it will sustain into the future, and obviously then give an investment reward that is appropriate to the asset owner's expectations, and that's something that we have to think about. But going back to Draka, feeding on that point, if we look at, so your client has come to you and you've dealt with that particular issue in that case where they had to look at their strategy and develop a strategy and look at their businesses. But what I'm observing in some of the roles I have now is that reporting has become such an industry that the activity that will sit behind the reporting is almost getting forgotten while we rush to put in place. Now, it can't be forgotten because we have to report on something, but the burden of reporting, and again, I think it's really useful for the audience to understand a little bit about that. The reporting then drives Paul's investment decision and indeed the asset owner, so they're expecting to see, Article 9, they're expecting to see all the...
Absolutely.
But talk to us a little bit about that.
And that is probably the biggest bugbear of many in the room at the moment in terms of what they might have to do in the future. So I suppose, in the last couple of years, we've seen the European directive. Europe is the leading light when it comes to corporate reporting, when it comes to sustainability reporting. And I suppose the challenge for most organisations now is, even if you're not caught by the new legislation that requires very extensive reporting, you may be interacting with a party that is. So what's happening is, I suppose in the next number of years, 50,000 European companies are going to be caught by something called the Corporate Sustainability Reporting Directive. Really intense form of sustainability reporting is the politest way of describing it. But what it's forced people to do is actually look at biodiversity, water, pollution and waste. So I'm thrilled from that perspective because we spend a lot of time talking about carbon, but there's a lot of other issues. But what it has forced is an industry of people within organisations trying to pull together extraneous data. So the actual standards that are in place at the moment have about 1,400 data points that need to be reported on. Now, anyone who reports even on 100 data points would say that's a bit challenging. So it's a real exercise in an organisation to even discover where that sits. So that is becoming a problem. And as you say rightly, Fiona, that many people are saying, hang on a second here, we're actually on a journey to decarbonisation or on a journey in terms of biodiversity, and this is all getting forgotten because actually I'm only being asked to tell me where your target is, how your metric has been moved. So I do think there is a degree of caution required across the board to say, let's remember what the true agenda is. And my view is reporting is about telling your story, explaining what you've done and how you've done it. The one thing I would say is different to any other reporting that might be financial or kind of driven by a kind of regulation. This one accepts that if you haven't done it, you can explain, I am doing it, this is my journey and trajectory. So there are aspects that are mandatory and aspects that are voluntary. But it's all about saying, where are you on your journey? But it is very cumbersome. And it will affect everybody, because if you're in the innovation space and you're wanting to work with bigger partners, you're part of their supply chain. And what you do in terms of human capital, what you do in terms of pollution, what you do in carbon impact, actually will need to be pulled through. So another story from another client. So they were working on a framework with the NHS in the UK, very innovative in the medtech sector, and they were in two different frameworks, working away, happy out, knew the framework was going to renew, no stress in the business, because each framework had certain requirements that sat alongside it. And they were like, yeah, no issue. And it was based on a kind of capital spend. The two emerged together. And all of a sudden, there's different criteria for that capital spend. And guess what? One of them was your carbon baseline. And they weren't informed that they needed to have it before. Now, they had done it in the background with me because it was kind of a journey. But it was just by chance that we had kind of got them to move along faster because the board went, that's a great idea. Yeah, we'll get that in place. Had they not, they would have had 6 weeks to do something that really was impossible to do in 6 weeks across the organisation. And that's an unpleasant place to be. That's not where regulation can catch you out.
Yeah.
And that's not, I think, great for anyone in the ecosystem from a sustainability perspective, because it doesn't give the right message. The purpose of the NHS was to make sure they're working with the right parties, but how it landed came across quite badly. And I'm sure there are many other frameworks and kind of organisations. I'm not having to go with the NHS, by the way.
Yeah.
But it just happened, literally like that.
No, absolutely. And even, I sit on the board of Network Rail in the UK in a similar situation where you look at their procurement or their supply chain, and whilst a well-intentioned policy decision at the board to only endorse companies right through the supply chain that could demonstrate their credentials for sustainability, suddenly no one tenders. So you suddenly can't find anyone to do the particular thing you need done, or the piece of technology, or you can't acquire it at the right price. So then what do you do? Then do you not do it? Do you have to pay up? Do you abandon your morality, as it were, in relation to that decision?
And there's a new one called societal value. So if you're tendering in the north of Ireland, you have to demonstrate what your societal value is as an organisation. Now, that might be really easy for a lot of people in this room in terms of innovation and what you're doing. But it's a hard question to answer, and how do you frame it? And that's going to come in, I suspect, to the Irish government as well, because they quite like it, which is good in a way. But how do you frame it? So there's a lot of these things that are coming along that are just disturbing what I would call the wider agenda.
Yeah.
But I think the intention is to make organisations more resilient, because there is transparency and comparability for yourself, so you can make good decisions. So there is a connection, but I think there's a pain point that we live through as this is all brought into place.
Yeah. And going to you, Paul, I wanted to just pick up on that and then ask you a separate question, really, in terms of when you read these reporting. So in theory, you'll be the recipient of these reports over the years to come. What sort of a lens do you bring to bear? Are you sceptical? Are you believing? Are you challenging? Are you making kind of clear-cut decisions? Are you giving, as Doraka says, the benefit of the doubt, believing that the journey? So I'll come back to you with my second question.
Well, I suppose in an ideal world, you would hope people have good consciences and they run businesses well and effectively. But going through the financial crisis and seeing the outcomes of people's interpretation of rules that weren't entirely clear, inevitably people just arbitrage those rules. So that's really one of the big causes of our financial crisis back in 2006 and 2007, both here and globally. So frankly, I welcome the fact that we have regulation, we have uniformity, we have a standard by which we will be able to judge, both at a company level or the behaviour of an actually investment management firm. I think if you leave an arbitrage, and the earlier panel, they alluded to carbon credits, this is a great example of a fiasco waiting to happen. Unless we get to grips with the fact that there is a different standard in California to the West Coast, to the East Coast of the United States, there's a different standard in New Zealand. There is an entire carbon trading infrastructure developing in China. We just don't have a uniformity on this. And when you don't, what you will have is arbitrage. We had a manager approach us to say that they wanted to work with us because they had a very efficient carbon capture strategy. They didn't have a carbon capture strategy. What they had was a carbon arbitrage strategy, which meant that if we did work with them, you weren't saving 1 ounce of carbon, but what you were doing was making money on the fact that everybody was actually managing this inefficiently, and it created this arbitrage effect on a global basis. Now, needless to say, we're not working with them because, again, it goes back to that conscientious behaviour. I don't think if the outcome of all of this is to find a strategy that gets around the rules so that you can actually deliver something that is less than optimal from a planetary outcome, then it's shame on us, and we will have the next generation, the generation after us, and after that again, looking back and asking, why did we not take responsibility? So I honestly think that's regulation, and from financial services perspective, and as a financial services executive my whole life, normally we're talking about not having regulation, but this one is the unusual situation that I personally believe that we can't rely on the industry's conscience on this, because people will look just for the arbitrage moment, and that is just the human behaviour we've experienced for decades and centuries, if not millennia.
Is there a piece, though, sorry, just dying to cut in there for a second, because one thing that I kind of experienced quite a bit is obviously every business wants to grow and make more profits and do better, to invest in whatever, in the business itself and in the communities they reside in. But there is a challenge that is really, really real as you transition and change your businesses, as you kind of take on new modes of doing business. You're not going to get the same return. And that's something that I see with a lot of boards and a lot of executives that say, Dork, I can't do that because like I've promised that we're going to get a 7% return on capital because that's what we've always got. I couldn't possibly go back into the board and say it's going to be 5. Like that would just be trouble. And I'm like, well, you're still making a return here. It's just a slower return. And it's that, for me, the mindset of kind of the business community needs to change because it's a bit like when I plant a tree tomorrow, talking to the plants earlier on, the trees earlier on, I'm not going to sit in the shade ever in my lifetime probably if it's a big tree. Yeah. I'm just going to have to see that tree grow. So there's a piece of me that says, as a business kind of community, as the analyst community, and across, we have to accept the kind of the portfolio effect of this sustainability transition. And if we don't, we're fooling ourselves because money has to come from somewhere.
Yeah, absolutely. And Paul,
and I think that's quite important, actually, as a point. I do think this quarterly-based reporting that we have for all companies now creates a behaviour.
Absolutely.
And again, it goes back to the comment I made earlier. If you create a rule that creates a behaviour, it's not necessarily the best outcome. So if you're a CEO and you're being judged on the next 6 quarters of performance, you don't really care about the next 60 years. You don't care about the next 6 years. So from that perspective, it actually drives the behaviour. So I think, yes, undoubtedly we have to accept that there's a longer duration to the outcome. I don't think you have to, in the longer term, sacrifice the return that you're making. So if you take oil companies as an example, like we've had a lot of protests in recent time about, like, the stop oil, let not invest in fossil fuels, which actually, frankly, is illogical because the answer is not, because it will still be around come what may for the next 30, 40, 50, maybe 100 years. What you have to do is just be a lot more sensible on how you ascertain or you get to the valuation on oil companies. So one of the things we did with one of our managers was actually really dig in on how they actually spoke to oil companies around net zero targeting, how they talked about stranded assets, how they valued those, how they got back to the intrinsic value of companies. And I think that's the way you're going to begin to change behaviour. You get a manager who has 40 billion in AUM, turning around and asking questions differently and explaining to an oil company, I'm not buying your shares because you don't have your 2030 target or your 2050 target doesn't compare with what I see with others, and your view on stranded assets is in our view, is an inappropriate net present value calculation. You nearly have to bring it to the unemotive terms that influence the CEO. And I think that that's part of that journey and that transition that we all have to accept in terms of the investment community, because they won't react. They will exactly, as long as everyone keeps saying, oh, you stay in your job because you have a 7% ROE, you will only target a 7% ROE. It's like natural, it's a behaviour bias that you actually create.
Yeah, and I just was reflecting as well that I think some of the oil companies, certainly the US-based ones, had their AGMs recently, and a lot of their climate initiatives were voted down. So again, and that kind of goes back to a sort of we've moved in one direction, now it moves a little bit back, and obviously you've given us some of the statistics earlier on in terms of where we kind of overall are in terms of big business's approach to supporting and funding and allowing some of these activities to take place with that longer term time frame. And that's certainly, directly what you've described is exactly the experience I have in boardrooms, is that everyone wants to do this, everyone is trying to do this, a lot of focus on the technical aspects of doing it, hence the supply chain and the SMEs and the technical improvements that we can put in place on particular parts of the business. But overall, if you're trying to refinance your debt and if someone's looking at you for a particular return or a particular investment decision and you're trying to overlay, well, give us an extra 10 years or an extra 15 years for this to play out, you might get a good hearing, and increasingly we will get a good hearing, but at the moment it's still challenging. I just wanted to ask you, Paul, then, we've got about 10 minutes left as well, I just wanted to ask you, for a lot of the folks in the room, what do you, for the 80 companies that come looking for investment from you, maybe some tips to share with people around sort of, things to look out for, things that you see as being really strong parts of their business proposition, or indeed the opposite, the weaknesses that they bring in?
Yeah, I think anyone who has a business and has set up a business obviously has a very strong passion for that. Otherwise, you're probably not doing it in the first place. However, I think really, well, that's important to come out, the commitment of the founders and their zeal for the business. It's to be very careful that it doesn't turn into or feel like missionary zeal. Because at some point along the way, you are dealing with people who are trying to work out where the longer term return is going to come from in this opportunity, because ultimately, go back to my earlier point, not because they're just trying to make it on their own book, They're actually thinking about, if I bring this to a pension fund, will somebody get a pension at the end of the next 20 years because of the actions I've taken today? It's a bit like the planting of the tree. The actions taken today by pensions managers around globally are actually deciding on what happens in 25 and 35 years' time for people who will actually need to draw on their pensions. So I think actually the missionary zeal is the one that would, it definitely feels like that it requires deeper investigation as to what is the balance between when I'm hit with an inflection point of a decision in the business, do I make the decision on an emotive term of constantly chasing this down, or do I have to amend my model slightly to reflect the fact that this is probably something that's much more commercially viable on a go-forward basis? So there may be the element of compromise matters within a business to watch out for as well. The other is the whole idea of science projects. We're Resolve Ventures are partners here, and these are the type of firms that we like to engage with in terms of when they're actually dealing with companies, they're looking for companies to help them grow and build on their journey and learn some of these pitfalls along the way, and actually get to the point where this is something that's commercially viable that begins to kick off into a much more attractive proposition, either as an acquisition target or as a company in their own right. In the vast majority of circumstances, they are acquisition targets. So you're building yourself to the point of somebody being interested in bringing this in as part of a portfolio. So I do think the area of climate tech is definitely one that and back to the regulatory point, I think that's going to be an enormously fast-growing area, because people will have to work out how to do, whether it's the reporting or whether it's the actual accountability around your carbon footprint. Trying to do this in-house in smaller companies is going to get increasingly difficult. So any SaaS-based approach to this, I think, will actually make a huge difference. I think they are very attractive companies for people to actually look and consider. And we tend to talk in the climate tech space to a lot of managers. That's where we have to actually try to be much more discriminatory, because we actually find that this is a space where we get quite interested, because it does talk to a critical path of growth that we think has a catalyst for not just the company itself to succeed, but all the companies that can use that technology, whether it's satellite imaging technology, whether if we think about the re-wetting of the boglands, we have one company that we really like that actually focuses on the Scottish peatland areas and assessing what the carbon benefit would be of a re-wetting of a significant portion of those. We'll like that, not just because it's great technology in the company, but because, as people start thinking about their carbon offset, this is an opportunity to actually show, materially show exactly what that is. And I think they're the sort of technologies that I think, if you think about it, there was no need for them to exist 20 years ago, but now they exist, but they now need to exist digitally, and they need to be available quickly to companies to take advantage of those. Okay.
Switching gear a little bit, and back to you, Doraka, just thinking about the skills needed. So again, one of the challenges that we face again at boardrooms and at sort of the executive level in large organisations, and indeed then with smaller organisations sort of selling into us, is finding the talent and the skills and the expertise we need. I think it's for those of us who are more generalists or maybe come from a financial services background, as essentially all three of us do, it's being able to engage with and understand and talk the same language of a scientist, of geologists, of biologists, of people with biodiversity backgrounds and such like. And then how do we foster that and bridge that kind of skills gap in the decision-making process, so that we understand each other in order to make better decisions.
And it's one that's really real, because when you look at my team, they're biologists, they're environmental scientists, they're engineers. That is the only way that I can provide the services to my clients. Real challenge in kind of the traditional business organisation, because it's a different culture, it's a different energy that comes with, if you're an engineer, you want to know exactly what's going on and drill through it and get it right. If you're kind of a bioscientist, you might have a different way of looking at stuff. So I think, as organisations look to kind of tell their story, you do need to consider, one key person is actually a data scientist, because data is at the heart of everything. So we're already moving in that way, because that is the new gold. But absolutely in this space, you do need to think about, well, actually, within your own organisation who is involved in the structure, invariably there are engineers, scientists, and all different types of backgrounds. So those skill sets, I think you have to kind of look and say, well, what do we want to have in-house? What do we want to have that we will use as a kind of a service provider? To your point, there's lots of different organisations that can help. But even what you're producing in the innovation space is really important. So what are the gaps? So I would say for many, it's that whole, the biodiversity space, there's very few. I know Aoibhinn Cawley is here, so she can stand up and give us an all-round of applause shortly. But there's very few people in that space who actually really know what they're talking about. And organisations don't actually, they're not going to invest in one person unless they're a very large organisation. So it's about thinking about, what you need as an organisation to tell your story, but equally, what are the gaps that are generally across large organisations? Mm-hmm. And you are right. Most of the time, my role is actually to translate to the board or to the finance team, say, well, this is what this looks like in kind of an English that might be more intelligible. That's not because I'm in any way brilliant, but I have the pleasure of working with people in this space. But it is a real challenge as you try to evolve your business and become resilient, because the resilience of the business is built on the kind of the financial structuring as well. I think Brendan mentioned earlier on, he spent 10 years of pain trying to keep the business profitable while he was germinating this really good idea. And that's not unusual in this space. Yeah. So it's just a thing to think about. What do you need and you have? I think most organisations I work with have unrecognised experts across their businesses who just don't talk to each other or are not brought into the same community. So what was maybe the finance team who dealt with all this is no longer the finance team, it's the ESG reporting team, and it has different lenses in the pillar and different skill sets. So that's maybe a way of thinking about it from a kind of corporate perspective, but from a kind of a innovation perspective, like saying, well, if I look at those three pillars, where might there be gaps or specialisations that not every organisation may want to have in-house, and what are the tools that we can develop to support that? So it's a great opportunity.
No, absolutely. And I think, just even looking at our education system as well, and that, again, is bridging the gap between those that are doing geology or biodiversity or doing environmental science, and that their time has come now into the kind of more traditional business organisation. And from your point of view, Paul, any kind of obvious skill gaps or challenges there?
Yeah, well, naturally, the financial services industry itself, our investment management in particular, it's an analysis game. So, expert groups are becoming more and more important, and you're seeing that developing as an industry. So people who can make commentaries on that and leaning into those. I particularly like the idea of, if you're working with, say, a climate tech fund, where that has the expert groups in-house, gives you a lot more reassurance that those eyes are on it. I won't know. I'll know that I like a story or an idea, but I'm not a scientist. I've no training of that sort. All my training is in financial services, per se, or in finance. So I'm assessing the numbers, but the idea itself, you need a validation for that. It also is, going back to the earlier point, one of the more difficult elements of when an idea comes to you, and it's explaining itself, and you sit in a room and you're wowed by a science presentation. That frankly is just an interesting presentation. It's not an investable proposition. What you have to take it to then is how is this an investable proposition, and who should you speak to assess whether that is the case or not. So an example was, we recently had a carbon capture presentation which came to us through a number of sources, and effectively it seemed like a fantastic idea. Fit a filter on factories, take all of the offset down into a unit, create methane, power up the that's then used to put renewable energy back into the factory, and then it all comes out again, and we keep going around in circles, and so it sounded great. And then we said, well, have you got a working model? And they said, we'll do a video call, and we ended up on a video call with basically somewhere in a kibbutz in Israel, which is I would say is a high chance this is going to be very smart. But the working capture was in the garage. So, if we had an institutional investor come to this discussion and get to that point of the diligence, I don't think we would have. Now, it could well be the greatest idea in the world. I just don't know. But what I do know is, and I'm actually going to try and structure that story and get people interested in it, it has to be more credible and believable at that stage to get them to actually move to the actual financials, and whether that's how robustly you can actually examine those. As well. So just by way of example, science projects are difficult.
Exactly. Well, I've learned as much from our two panellists today, certainly, and I hope everyone in the audience did as well. Time is up for us, and we're going to break for lunch now. Thank you very much.
Thank you.
Thank you.